Our job is to be the retail operating system for the millions of merchants that use Shopify. And the way we do that is by future-proofing their businesses. So whether it's things like tariff calculations, or it's things like moving online or offline during the pandemic, what we try to do is make sure that Shopify merchants are simply better prepared for anyone else. And what it's done is it's built this incredible trust battery with the millions of businesses that use Shopify. And the end result is that not only are small businesses coming to us, but the largest companies on the planet are also migrating to Shopify, and that's why you're seeing these incredible results.
Right. No, I understand that, and I appreciate the nimbleness of modern corporates, but comparing the tariffs to the pandemic might not be so comforting to some.
Look, we've been hearing about the tariffs and even the de minimis changes since early March, and we just haven't seen anything yet. So we'll continue to monitor it, but so far we've seen nothing that changes our business or the business of our merchants. I mean, on the call today, we mentioned that we are seeing some increase of pricing by some of our merchants. We'll continue to monitor that, but beyond that, we haven't seen any slowdown.
Harley, a broader question from me. I'm curious as to how you're using AI at the company itself and what your expectations are in terms of the efficiencies perhaps that you can introduce both for your customers but also for Shopify itself.
Yeah, we've been, I think a lot of companies will benefit from AI, but I think Shopify specifically has an opportunity to leverage AI both internally and for our merchants. From the merchant perspective, I mean, we talked about small businesses earlier. We built Shopify has an opportunity to leverage AI, embeds AI across the entire product of Shopify. So whether it's simple tasks like product descriptions or creating better product photography, or it's figuring out, what orders or what products and what SKUs are selling better and where to place marketing dollars, we think we can actually create these superpowers. We call it sidekick because every merchant needs a sidekick that allow them to grow business at a much faster clip. But internally, we're leveraging AI in two ways specifically. One is on making our product team and our engineering team a lot more efficient, but also from a support perspective, making sure that when you call Shopify, when you want to talk to someone, that the high quality conversations are done with a human, but those low quality conversations where you need something like configuring your domain, AI does a really good job of that. So we've been an AI native company for a long time. The way we think about it is being AI reflexive. And that's not just necessarily in the engineering team or support, that's across the entire company.
Now, Harley, I've been trying to figure out for our viewers the distinguishing in e-commerce. And look, correct me if I'm wrong, but I feel Amazon is kind of like stuff you need, household staples. You guys are stuff you want, favorite brands, retailers. Maybe that's also a secret.
Yeah, Amazon's a great partner of ours. We've been working with them for a long time. In fact, their daily deal site, Woot, just migrated to Shopify, so it's now being powered by Shopify. We think Amazon's an incredible company, a great partner of ours. But Amazon is really the place where you go for the things that you need, household staples, for example. But for the stuff that you want, that you love, the brands and the products that are deeply personal to consumers, those are on Shopify. Whether it's Mattel or it's Viore or it's Alo Yoga or it's Canada Goose or some of the others I mentioned, those brands are the ones on Shopify. And what we're doing is creating this retail operating system so that whatever surface area is where consumers are spending their time, again, online, offline, or places like agents now, they are able to get in front of the consumer. And I think that's creating this incredible flywheel effect that more businesses are coming to Shopify at a higher clip.
Excellent, Harley. I do want to point out that when the stock was at 79, 80, Harley came on. This was a big drop and said, listen, I don't care. Let me tell you why we're great. It was a very telling moment, and you made 70 points since he came on. Harley Finkelstein is the president of Shopify. Thank you, Harley.
Thank you. Crushing the NDX today. Meantime, Dow's gone negative as Disney and Amgen weighing on the index. Disney's down 4%. We'll be right back. Jim, it was a packed hour. What's on
Yeah,
tonight?
well, Carl, had I had a chance to do just a stop trading, I would have mentioned Astera Labs, ALAB, up 43. A lot of that is because of the NVIDIA deal that they signed in May, but I don't have any time to talk about that. I have Planet Fitness on. Their numbers are just incredible. And then Jason Robbins, DraftKings, I mean, coming into football season, coming in hot, as opposed to, I didn't know I came in cool. I'm sorry. I didn't even get to mention Jurist and Ned and Jay Shishu, which is a number that even competitors are saying is incredible. And Alex Karp, congratulations again for getting the stock up. What a guy.
What a guy.
What a sweetheart.
Jim,
Always
That word is
tomorrow,
not used
man.
by anyone in the world. Remember, he also has the pistol competition he does.
we'll see you tonight, Jim. Mad Money, 6 p.m. Eastern Time. When we come back, an exclusive with Lucid's interim CEO on the challenges facing the EV maker when we come back.
Mishap or collision, unless, of course, specifically so ordered by its pilot.
It is all about.
Good Wednesday morning. Welcome to Swalk on the Street. I'm Carl Quintanilla with Leslie Pickard, David Faber, live at Post 9 of the New York Stock Exchange. Sarah has the morning off. Markets holding in there amid a wave of important results from corporate earnings. McDonald's, Uber, AMD, Disney, Shopify, 10-year pretty steady at 422. Coming up on today's show, we'll talk to the CEO of Lucid, fresh off earnings, get some insights into the EV market as that stock does pull back a bit on a miss and softer guidance. Plus a lot more on today's blue chip earnings, including McDonald's and Disney, which, as you may know, just inked a major deal with the NFL.
But first, we're 30 minutes into the trading session. Here are three big movers we're watching this morning. Apple on the move after the White House said the company will invest another $100 billion in the U.S., focused on beefing up domestic manufacturing. That's on top of the $500 billion it pledged back in February. Those shares up 3.4% right now. Meantime, AMD under pressure after missing earnings estimates. CEO Lisa Su joined last hour to discuss the numbers and their shift toward manufacturing here in the U.S. Take a listen.
We're very supportive of manufacturing in the United States. I think it's good for us to have resiliency across the supply chain. We have a very strong supply chain. We continue to make sure that we're in active dialogue with the administration as we're going through this. But, clearly, U.S. manufacturing is a good thing, but we also have to recognize semiconductors require a global supply chain.
And sticking with chips, Supermicro also in the red, plummeting this morning after weak fourth quarter results and soft guidance. Those shares down more than 18% right now. Let's get to Christina Partsenevelis with more on Supermicro. Christina.
Thanks, Leslie. Well, the AI server assembler really is caught in the classic growth trap. They're trying to scale production to meet AI server demand, but they're just burning through cash and sacrificing margins in the process. Supermicro CEO Charles Liang admitted on the earnings call they lacked working capital to expand as quickly as needed, which is why they had to issue a $2.3 billion convertible bond offering just in June. The margins really tell this story and why you're seeing the stock down so much. They collapsed from 18% at the end of 2022 to under just 10% right now. That's what happens, though, when you're assembling expensive AI components, but you have to compete primarily on price against big players like Dell and HP Enterprise. Mizuho points to customer concentration as a risk. There's about 4 customers who contribute over 50% of revenues. One of them is just massive. The bull case, though, hinges on their technical advantages. They're typically first to market with new AI server configurations, and their liquid cooling technology becomes more valuable as NVIDIA rolls out more powerful chips because you got to cool them down. But they need to prove they can translate technical leadership into sustainable profitability and not always have to wait on NVIDIA to deliver their next set of chips. That was a major complaint for this quarter as well. Supermicro, though, is riding one of the biggest infrastructure buildouts in tech history, but investors just are learning that being a picks and shovels play doesn't guarantee a gold rush profit when everyone else like Dell and HP are selling shovels too. Guys?
A little reticent to put any numbers on these China shipments if and when they begin.
Yes, that was a major concern for the upcoming quarter. But if I were to point out, NVIDIA spoke to analysts after the United States said they were going to be putting these export controls and allowing those chips to be sent. And NVIDIA said that you wouldn't actually see it until Q3, if at best Q4. Why? Because these licenses take a long time to get in place. There's paperwork. And so for AMD's case, just especially in Lisa Su's interview today, as well as on the earnings call yesterday, she was very unsure as to where they stood with those licenses. I'm paraphrasing, but that was the takeaway from a lot of Wall Street, and which is why you can't really price it in. But we knew this. So the negative reaction to the stock shouldn't be contingent on the AMD chips going to China. There's the drivers, the GPU they said they're going to be ramping into this year and to next year. They have next iterations. She called out NVIDIA specifically, saying that their chips compare to NVIDIA's Blackwell 200 when it comes to inferencing. So I don't know if we really need to pay as much attention to China for this downward trend on the stock right now.
Right. Christina, thanks. Talk soon. Christina Partsenevelos, busy day for semis. Let's get to McDonald's this morning. They did serve up an earnings beat. EPS and revenue came in ahead of expectations. Global comps up 3.8. Let's bring in Evercore ISI analyst David Palmer, has a buy and a 350 target on the stock. David, good to see you. Comps were a bright spot, and yet the commentary was, I guess, qualitatively a little cautious. What's your take on it?
It was actually a really good earnings call. The Q&A really focused on the fact that they need to do more on value for that 50% of their business in the U.S. that is not really tapping into the digital value or their existing kind of $5-ish meals that they have. In other words, the core menu, the premium core, is those combo meals are many times over $10, and they're going to get after that. That was a very bullish comment. It certainly is going to be one that gets on everybody's mind who deals with not only McDonald's stock, but other stocks in the space, because McDonald's is really coming for the value perception that they want.
Right. We heard from Chipotle not long ago. We mentioned Dine Brands with Kramer this morning, down 8% today. Is all of this folding into a tapestry about at least the lower income cohort?
Yep. Yeah. And not only that, but you gotta win with all consumers. Right now, it looks like there's a consumer that's going to fast casual, albeit that's been slowing within the fast casual space. You're seeing remarkably strong results in casual dining. Some of those, like Chili's, have poked fun at McDonald's and the fact that their burger prices are and their combo meals can be more than the $10.99 3 for Me, which features a burger at Chili's. So McDonald's needs to firm it up on the premium core as well, and they're on the case. But also the power of national advertising in value is very is clear. The $2.99 snack wrap really has been working, and they introduced that on July 10, and their comps have been up mid-single digit ish since that time. They've locked into $2.99 for the rest of the year. So between that and some of the other marketing they have coming up in the second half, people are getting more and more excited in that system for the U.S., which is the key catalyst that they need.
How much of it is the absolute price point versus the perception of value? I ask because if you look at kind of the landscape for fast casual right now, you've got McDonald's seeing this pretty sizable turnaround here in the U.S., but Chipotle on the other side, maybe Pizza Hut on the other side. So how would you kind of characterize those companies that are standing out in this environment?
You mentioned some players like Chipotle there that they don't do advertised price points, and that would be inconsistent with the brand. So they just have to have inherent value, kind of like a Texas Roadhouse, and they have to play by their brand rules. They can do some things on their app to get those, maybe a lapsed user with a freebie here or there, but they're not going to be doing what McDonald's can do, which is a national price pointed value program, and that can really make up for a lot of ills for McDonald's in a hurry. McDonald's overpriced during COVID. They way outpriced wages during that time period. Food costs are pretty low as a percent of sales. They had to do a lot of that to make up for labor, but they overdid it. But they can really just instantly solve that with a national price pointed advertising, and it leverages that huge advertising scale these guys have in addition to the digital tools. So McDonald's has a clear thing that they have to do, and they're going to probably get it done here in the second half.
So, David, given the recent price action on Shack, on Chipotle, on Yum, is QSR still where it's at?
Well, there's different types of stocks. They're in a world of inflation and a weakening dollar. Some of those global franchise names, if they can get their act together in the U.S., and as the company was saying on their last on this earnings call, McDonald's, you have to be right on all areas and innovation and marketing news as well as value. The ones that have been doing the best on that are Yum Brands. McDonald's is going to be improving. QSR just needs to just show that it can survive with McDonald's and coexist with them. So far, they're doing quite well, even in July. So we like QSR, McDonald's. In terms of Chipotle and a name like that, you're probably going to look to 26 for the best performance there, because their comparisons start to really ease, and they have a lot of tools that they're going to be deploying by then. But you're probably going to have to be more patient with the fast casual zone for reacceleration.
Right. I should have been more plain. I was asking about the category QSR, not the ticker, but I run into that every now and then. Finally, do you anticipate any relief on at least beef prices in the next 12 months?
Right now you're seeing a remarkable amount of inflation, and it's bifurcated among steak versus hamburger. Hamburger is some of the worst, and McDonald's talked about they have 70% of their company stores in Europe, and their inflation for beef in Europe was a remarkable 20%. That reflects some of the global trade conditions as well. The hamburger is more traded overseas, but some of the high-end cuts, for example, in steak are not that bad. So the first thing we're going to find is that some of the steak players in casual dining are not going to be hit quite as hard as what we're seeing in hamburger land. But as far as the beef cycle, it's going to take 1 or 2 years for beef prices to be in relief. It's going to take a bit.
Right. Yeah. That goes deep into the the cattle industry and what they're going to do with heifers and all that. David, appreciate it. McDonald's definitely helping out the Dow today. That's David Palmer joining us on MCD. Get a roadmap for the rest of the hour. After the break, former Goldman Sachs Asset Management Chair Jim O'Neill's with us. We'll talk about these fast-changing tariff headlines and the impact on the market, the dollar, and more.
Plus, Disney scores a deal with the NFL. We'll have details on that new agreement to boost ESPN's new coming sports package.
And we'll talk to the interim CEO of Lucid as the EV maker moves in reverse this morning on weak earnings. A big show ahead. Squawk on the Street is back after this break.
Some breaking news on trade this morning, just crossing the wires. The White House says an additional 25% tariff will now be imposed on India. That brings the total tariff to 50%. All of that due to what the White House calls Russian oil purchases on behalf of India. We'll get some more details as we get to them. But we mentioned earlier with Jim, David, that the relation between the U.S. and India has become a little more fraught, because India is in a position where they're saying you don't need to dictate to us where we buy our energy, and clearly we're trying to put some leverage on Putin and Russia.
Yeah, we have not chosen to do the same to China, of course, which is also a big buyer of Russian oil. And this goes back to Apple as well, shares of which are up almost 4%. An announcement coming later today about increased investment in the U.S., but remember, many of the iPhones for the U.S. market are made in India, and so an exemption from now a 50% tariff would seem to be something very important for Tim Cook, the company's CEO, to be able to get from the Trump administration. All right, let's continue to talk a bit about macro and tariffs and all other things. Jim O'Neill, former UK Treasury Minister, former Goldman Sachs Asset Management Chairman, joins us now. Why don't we start off on tariffs, particularly on this news in terms of India, Jim? I mean, it's a moving target on so many different countries, whether it's India or Brazil or others. What are your latest thoughts?
Well, he seems to be having a go at the two BRICS that most people would have thought were the least likely, given that India and Brazil are democracies. And of course, I think the Modi government will be still pretty stunned, given that when Modi visited Trump earlier in the year, I think the general view in India was that they'd kind of figured a way of the buddy system working so well for them. So this is has broader connotations than just the obviously very important in itself tariff influence on price making in India. And I can't help thinking that, the flip side of Trump occasionally threatening the whole BRICS crowd about if you do anything to sort of threaten the supremacy of the dollar, you're going to get whacked. But by doing things like this, India especially, which was probably the one that was least into the sort of anti-US part of the BRICS group, might start to have a bit of a rethink about that. And I would have thought the last thing the US would have wanted is India and China trying to be a bit friendlier than they've been for a very long time. So this has got all sorts of potential big picture ramifications beyond just the very important thing of the tariffs. But separately from that, of course, what stands out is how generously on a relative basis China seems to be being treated about a growing number of issues, which in itself is not what you would have expected 6 months ago.
No, and I made that point even about Russian oil. Yeah, they're at 30% right now. Those talks continue. Now, that said, of course, things can change very quickly. And as you well know, leading to, of course, a word we've used so often and many others have, uncertainty. I mean, I am curious as to what your thoughts are about just how uncertain it can be, given we still don't know what the playing field really fully looks like, other than we do know here in the U.S. we're talking 15, 18% tariffs probably being the average.
I mean, David, all I can say is a bit facetious, but I'm glad I'm not the CEO or CFO of a major global multinational, because you wouldn't have a blinking clue what you're supposed to be doing the following week or possibly the following day. So I guess the most logical thing which is going on is that the inventory management of any of these kind of companies is just being a lot more closely monitored and managed by all sorts of different industries, because what else can you do? The other thing which obviously follows from it, bringing it to domestic state of affairs in the US, we're going through this mood at the moment, as exemplified by the relatively strong bond and equity markets, that it doesn't seem to matter, and the US can just sort of sail through it, which I can't imagine that is going to be a persistent mood, because it does not make sense. I'm still sufficiently old school that the idea that the US can apply this scale of tariffs and it to have no sustained impact on real incomes or relative prices and possibly inflation in the US seems to me to be slightly in the crazy category.
You know, that's the question, because to your point, the administration would say, hey, the economy's doing just fine. We're collecting a lot in revenues, by the way, offsetting our budget deficit to some extent. So when do we start to then really feel this impact that you're saying we cannot potentially avoid?
Well, of course, this takes me directly back to last week's latest controversy, and arguably one of Trump's biggest in response to the labour market figures. I think I was joking with some of your producers when we were setting up the time to come on. I remember the days where a pretty prominent primary bond dealer nearly went bust betting on a non-farm payroll number, and a few months later, by the time it had been revised, they would have made a fortune if it would have been the same. So the idea that the current leadership of the Labour Department is fiddling the employment numbers is kind of completely crazy. But you know, if you put that in the context of the high frequency leading indicators like the ISM survey that we had just the past couple of days, it looks to me that the US economy is slowing, and I don't really see that many indicators that are suggesting anything to the contrary. Fortunately, they're only slowing gently, and what are the causes of that are, as always, as complex as ever, but it seems to me there's some pretty obvious candidates, including all this uncertainty, and the fact that companies are having to somehow try to balance between keeping profit margins up and adding on import prices that are going to end up partially, if not significantly, going to the consumer.
Do you expect that to slow even further from here, especially given just the cross currents of policy that you outlined, what's happening, at the Fed, what's happening with tariffs, what's happening with the one big beautiful bill?
Yeah.
It feels like there's a lot that's kind of crossing over itself that makes the second half of the year even more uncertain.
I mean, I think the one thing that is emerged from the past week from all of this, with the caveat of let's see the next inflation data, is the Fed is, as the markets have quickly moved towards doing, much more likely to now start cutting rates. And obviously that should help to a degree. But I think unless Trump can find a way of somehow not wanting to lash out at country X or Y whenever he sees something that he disapproves of, whether it be the treatment of a past leader in Brazil's case or whatever it might be. Switzerland, I mean, the whole country of Switzerland is in complete bafflement as to why they've been whacked with so much tariff. And unless there's a bit more calmer view about all of that, I think the uncertainty, to be honest, as crazy as it sounds, might only get even more, which makes the job of policymakers, including the Fed, increasingly difficult, in my view.
Jim, going to leave it there for now, but always appreciate your insights. Thank you.
All right, thanks for having me on, guys. Good luck.
Still ahead, the CEO of digital lender Upstart joins us as that name falls this morning, down 12.7% despite solid earnings. And later, we'll talk about the big news surrounding Disney's multi-billion-dollar deal with the NFL. And McDonald's, not the only consumer-facing name on the move this morning. We'll check in with the CEO of restaurant fintech company Toast as they warn of bigger tariff impacts ahead. Don't go away.
NBC Plus.
Welcome back. Upstart, an AI-powered lending platform, sliding this morning down 13.5% despite beating on top and bottom lines. The company partners with banks and credit unions to provide credit products and automate loans. This is banks' look to further integrate AI into their business models. Joining us now, Upstart CEO Dave Gerard. Dave, what do you make of the stock reaction to what on the surface feels like pretty good earnings this morning?
Yeah, Leslie, look, I mean, obviously I wish it were better, but, I sleep well at night knowing that long-term the stock is going to follow the performance of the business, and we feel very good about that. Q2 was a great quarter for Upstart. We grew 102% year on year. We returned to GAAP profitability. 92% of the loans on our platform are completely automated by AI. Most of the funding, the majority of the funding on our platform comes from long-term committed partnerships with private credit. We beat guidance on the top line and on the bottom line pretty significantly. So a little hard to, understand the reaction, but that's what it is. We just try to keep going and build the business.
Yeah, I saw the 92% figure in your slide deck of the loans that are fully automated, and that's up from 73% just 3 years ago. What drives the higher automation, and why are those that are automatically reviewed more likely to be approved than the ones that are manually reviewed?
Yeah, it's it's the power of AI. A loan product is really a function of risk, and the amount that you pay on a loan and the process you go through is really about the lender de-risking that loan and trying to make it work for them. And when you bring AI into the picture, you can do a lot of that through models and much more quickly. So what you get is a process where rather than wait a day or stand in line or call somebody, walk into a bank branch, everything happens instantly and the loan is available instantly. Those convert a lot better for a lot of reasons, but the most important is it's right there when you are asking for it. If you don't have to go retrieve some documents or upload them or again, drive to the bank and sit across from a loan officer, obviously things are easier for you. So, instant approval is really good for our lending partners because it brings down the cost of lending. The AI does a better job of understanding risk, but it makes a far better product for the consumer who can just get that credit in a click.
What are the models telling you about the risk of the consumer right now? I know the demand side is there. Originations up 154% in the quarter year over year, but can your borrowers repay their debts?
Yeah, the American consumer has been in what I would call an elevated risk state for quite a long time now, a couple of years. We really look at that as what is the financial health of the American consumer, and what you see is, personal savings rates are really low compared to sort of a long-term average. Default rates across every category of lending, whether that's cards, student loans, auto loans, are elevated relative to where they would have been pre-COVID, pretty significantly. But we've been underwriting to this standard for a long time. So our loans are very calibrated, and our credit is performing exceptionally well. But what's really going on is prices are very high. Credit is not as accessible as it might have been a few years ago. And but that's the nature of our business, is we have to calibrate properly to the state of the market. But we generally think there's more upside than downside because we're already sort of in a very conservative underwriting position. And there are signs, as you see from a lot of your guests, that consumers are pulling back, right? Whether it's retailers, restaurants, airlines, everybody's seeing sort of price sensitivity from the consumer. From our perspective, that's a great thing. We like to see people being more responsible with their money, earning more than they spend, and beginning to save more.
Right. What do you think the picture looks like going forward on credit demand? Do households look to take on less credit because they're nervous about their jobs, or actually do you think they're forced to because their disposable income or their real wages, for example, take a pinch?
Yeah, Carl, it's really more the latter. I think, over our long history, we almost never see what you would consider a real softening of demand of credit from the consumer. It's just always there, whether it's buying forward on something, buying the next home, paying for school, et cetera. There's just always the need there. And, we can't always serve it because the risks will change, the interest rates will change. So sometimes we can't serve all that credit. But kind of what you might consider the gross demand from credit from the consumer almost never varies. It's just in the U.S. It's just kind of how we're built, and it's always there.
Yeah.
Dave, I'd love to just come to a broader theme. I mean, the scaling of AI in your own business, the improvements you've seen in the models. I'm just curious how you view sort of AI, broadly speaking, its usage in the enterprise. in corporate America and what your expectations are, given your own experience at Upstart and what you've really seen over in just the last, let's call it, year to 18 months?
Yeah, I mean, I've been in the technology industry for 30 plus years, so I've kind of seen it all very early in the evolution of cloud at Google. And there's really nothing anybody has seen anything like this, how quickly it's evolving. It's gotten to a point where the technology has gotten far ahead of anyone's ability to actually make products with it and make use of it. So it's a really unique situation. I think for us, AI is our product, right? So it's a little different from how companies are maybe reducing number of employees or automating things inside. We're doing some of that stuff. But for Upstart, the core for us really is we're creating a product that is entirely powered by AI, which kind of means everybody should be sort of persistently and permanently underwritten. You should be able to get the very best rate for any form of credit in a single moment. And that's kind of a different world than any of us who grew up applying for a loan, whether that was a student loan or, God help us, a mortgage, the process you've gone through historically. And now we're just imagining that to be completely gone, that credit is something that's just there for you with in a moment of time when you need it, the very best possible rate. These are the kind of changes that I think we expect across so many parts of our lives because of AI. So look, we're, not shockingly, we are AI optimists at Upstart.
Yeah.
Of course.
And of course, the financial services industry is spending billions on AI to automate things just like you outlined. So we'll keep watching that space. Thank you, Dave.
Thanks, Leslie.
Let's get a CNBC News update this morning with Silvana now. Hi, Silvana.
Carl, good morning. The Kremlin called talks between U.S. envoys Steve Witkoff and Russian President Vladimir Putin useful and constructive today. So the meeting comes just 2 days before President Trump's deadline for Russia to agree to peace in Ukraine or face new sanctions. According to the Kremlin, Witkoff and Putin spoke for around 3 hours. The White House has yet to comment. Sean Diddy Combs' defense team has reached out to President Trump to request a pardon on his prostitution-related conviction. Now, that's according to NBC News. President Trump said last week in an interview on Newsmax he was approached about a pardon, but he did not announce a decision. Combs faces a maximum of 20 years in prison at his October sentencing. And Republican Senator Marsha Blackburn announced today she is entering the Tennessee governor's race in 2026. Blackburn, an ally of President Trump, will compete against Representative John Rose in the primary. They are running to replace term-limited GOP Governor Bill Lee. David, I'll send it back to you.
Thank you, Silvana. Well, after the break, we're going to talk a bit about Disney's earnings and that new multi-billion-dollar deal with the NFL. Of course, the company continuing to add more sports content as it gets ready to launch ESPN Plus. Speaking of Plus, Lucid and Rivian under pressure as results from both EV names disappoint. We're going to talk to Lucid's interim CEO, find out whether he sees a bigger EV slowdown coming. We're back in a moment.
and make it count.
Shares of Disney off the lows, but still down over 3% this morning after the company reported earnings. A lot of focus on experiences, perhaps some concerns coming in, but generally quite strong there in terms of the results that we saw. Why the negative reaction? Well, looking at a couple of analyst notes this morning, have had a couple of conversations. Attendance growth did decelerate over the course of the quarter in terms of the parks. Maybe, Orlando, you've got some more competition there, although they claim they're not seeing anything from the likes of Comcast's Epic, for example, which opened. Also, Disney Plus subscribers didn't grow, at least in the U.S., and so maybe that's a bit of a concern. Kind of looking because, overall, a fairly strong quarter. Linear networks, yeah, it was weak, but who doesn't expect significant weakness there? Interestingly, not going to be reporting DTC subs anymore. That's something that Iger had actually pointed to when he did join us last quarter, I think it was. Not for this quarter, of course, as well. Hugh Johnson was a guest earlier on Squawk Box. The big news, though, is the deal with ESPN, going to be owning 10% of ESPN in return. Disney will take control of Red Zone, of distribution of the NFL networks, and a lot of other things. Bob Iger did talk about it on the call, what that NFL deal will mean. Take a listen.
With the NFL deal, we have the ability to bundle NFL's Plus Premium service, which includes Red Zone digitally, and we'll bundle that with the trio bundle of Disney Plus, Hulu, and ESPN, and with ESPN, and that's also an opportunity to lower churn, increase engagement across basically the apps that we'll be selling.
Yeah, and generally being viewed quite positively, at least again in some of the notes that I've read this morning. But we are, seeing some weakness there. I mentioned this earlier. A couple of people who follow, the hedge fund community, which on the buy side follows so closely, sort of guidance. It was 6 to 8% for experiences, but they seem to be at a 9% increase coming for the next quarter. They didn't say 9%. Maybe that's had some impact. Always difficult to necessarily know exactly what it may be that's being the focus.
Yeah, my personal channel check during the quarter indicated a lot of crowds, but perhaps that was just too myopic of a...
Were you there?
I was at Disney World 2 days.
Really? How was it?
Very busy.
Very busy.
But I think it was the time of, we went over spring break, so.
Oh, yeah, for sure.
Not a good sample size.
Usually a busy time. There's also a theory that Epic Universe, for example, creates a positive halo for traffic as opposed to stealing share, for example, because families go down and they do both.
That's right. And they claim they've seen no impact, or at least that's what I've heard. No impact at all. And obviously cruises also continues. And interesting when we view it more broadly in terms of the strength of the consumer right now, that they are not seeing perhaps what had been a concern in terms of some weakness.
When we come back, Lucid trimming its production forecast as execs call out a challenging macro backdrop. We're going to talk about it with their interim CEO in a moment. Later on, a look at the new crop of billionaires being minted by the AI revolution. When Squawk on the Street continues.
Wealth.
Welcome back. Check out shares of EV maker Lucid getting hit this morning and adding to some losses on the year after missing revenue estimates, reporting a larger than expected loss per share. Joining us this morning is Lucid's interim CEO, Mark Winterhoff, along with our own Phil LeBeau. Morning, Phil.
Good morning, Carl. Mark, thank you for joining us today. Carl set us up with your results coming out of Q2 and your guidance that you're going to be trimming full year production. What's the biggest issue you're facing right now?
Well, maybe let me start with some positive points of Q2, because despite of all the challenges, we still managed to have the 6th consecutive record quarter when it comes to deliveries, and we also had record production in Q2. We certainly had our challenges, and I think the biggest one here is trade policy and tariffs, which had impact on our cost base. We had an extra hit on our gross margin that we didn't expect to be that large in Q2, but it will actually even itself out to what we guided before in the remainder of the year. And the other big topics that hit everybody and us, thankfully actually not, was the topic about magnets, availability of magnets. We were able to overcome that issue, and it did not hit our production in Q2. In contrast to many others. And we solved the problem also for the remainder of the year. But the whole topic about changes in tariffs, in trade policy, and then also when it comes to tax credits is something that keeps us up at night.
Mark, are you getting the raw materials that you need out of China? Because so much of the EV supply chain is routed through China. And yes, you're making adjustments, but is that still the main choke point?
Well, that's what I just mentioned. That was a big topic in Q2. And if it wouldn't be for our engineers and our team reacting very nimble and fast, we would have stopped production in Q2 at some point. But it didn't happen because we were able to overcome it. And we have also now, particularly when it comes to the raw materials and the magnets, we have now all the licenses that we need secured for the remainder of the year. We have also a number of new initiatives that we have, changing the chemistry of the magnets, which kind of rare earth we are using, or even going away from rare earth. Plus, last but not least, sourcing from other markets. So I think we are actually in a good place right now.
Mark, you guys announced last month that, or just a few weeks ago, that you're going to be partnering with Uber and the autonomous vehicle technology firm Nuro to develop autonomous vehicles. From your perspective, can you roll out those first ones as you have indicated, but by the end of late 26 next year?
Yeah, I mean, we are in the process right now and working with the Nuro team in particular on the development. And, everything that we see right now is that we are making great progress. And we actually hear from them that they were totally astonished how fast we were able to integrate that into our vehicle, which is due to the fact that our Gravity is already very well equipped to, be a platform for autonomous driving. So we're very confident of that we are able to do that. And, then starting end of next year with rolling those out in the US and then also globally.
Sir, it's David Faber back in our studio. I'm curious, with adjusted EBITDA negative 632 million, I know you have, 3.6 billion in cash, is at least what you said on the call. Total liquidity of about 4.8 billion. But how much do you have enough? Do you have enough capital to get you where you need to be, or are you going to need to raise more, and perhaps from your largest shareholder, the Public Investment Fund of Saudi Arabia?
Well, as you said, we currently have 4.86 billion in liquidity, and that will take us. It hasn't actually changed into the second half of next year, and we will, we will raise capital if it is appropriate for us. We are opportunistic when it makes sense, and we will do that when it's needed.
Well, when's it going to be needed? Do you have any sense?
Well, that's something that again, we're doing this right now. We are funded until the second half of next year, and then when we see it appropriate, then we'll make actions on getting additional funding if needed.
Mark, it's Phil again. I don't mean to beat a dead horse here, but because the supply chain is so important and the trade negotiations with China, they show no sign of being resolved anytime soon. Where are you now sourcing that you were previously sourcing from China? Or is it simply that you're still sourcing China, but you simply have the licenses through the end of the year?
The licenses are mainly because for the rare earths, not for other things. I mean, the whole industry has a very global supply chain, and we have the same. We still have percentage of our parts that we need for gravity and for air from China, but it's actually a small percentage. So we think that we are in a good place. We also have, right now we're building all of our vehicles in the United States. So we are making changes right now in order to be more resilient to these discussions. You may have seen that a couple of weeks ago, I attended also the launch of the new Panasonic battery cell plant in Kansas. So the vast majority of our battery cells will come from the US for our US production soon. We have also struck a lot of deals with graphite suppliers because just producing cells, for instance, which is the biggest individual BOM cost element of an electrical vehicle, wouldn't really help you if you still would have to import the raw materials. So we are doing that as well in order to be more resilient.
Mark Winterhoff, the interim CEO of Lucid. Mark, thank you very much for joining us today. Guys, I'll send it back to you.
And thank you, Phil. Thank you, Mark. Great conversation there. Coming up, the new AI billionaires. Advancements in artificial intelligence are creating wealth at a record pace. We'll look at who is cashing in next. And don't forget, catch Squawk on the Street anytime, anywhere. Listen to and follow the Squawk on the Street podcast. We're back in a moment.
Every spin.
AI frenzy creating dozens of new billionaires a month. Just what we need. Robert Frank here with a look at who exactly is cashing
you're
in.
a wealth manager, you like them. News today, David, that OpenAI is seeking a valuation of $500 billion. That's likely going to add to the fastest billionaire boom in history. There are now 498 AI unicorns. That's private AI companies with valuations over $1 billion. That according to CB Insights. Now, 100 of them were created just in the last 2 years. Many of the founders, early investors, even top engineers now have equity stakes that put them in the 3 comma club. All 7 co-founders of Anthropic are now billionaires. It's raising money at a valuation of $170 billion. Alexander Wang, he is, of course, the co-founder of Scale AI, got $14 billion from Meta. His co-founder, Lucy Guo, also a billionaire, just bought a $30 million mansion in LA, so she's got some liquidity. The 4 founders of Perplexity, all now billionaires with its valuation of over $18 billion. And Mira Murati, who launched Thinking Machines Lab in February after she left OpenAI, has already raised $2 billion despite no product and no revenue. Publicly traded AI companies also creating record wealth. NVIDIA, as we talk about a lot, created at least a half dozen billionaires so far. Jensen Huang, now the 8th richest person in the world with $155 billion. And then can't forget CoreWeave, creating 4 new billionaires with CEO Mike Intrater worth over $7 billion. Now, for the full list of new billionaires and the full story on the AI wealth boom, you can sign up for the latest Inside Wealth newsletter that's out tomorrow morning at cnbc.com/insidewealth. That's cnbc.com/insidewealth.
Now, this is obviously based on their ownership stakes normally.
Yep.
You mentioned liquidity because I saw that $30 million home as well. I think she's 34 years old or something along those lines. But it is a key here. You're a billionaire on paper, so to speak, because of your ownership, not a billionaire in terms of what you got in the bank in cash.
And that's what's different among many things between this AI boom and the dot-com bubble that we saw in the late 90s. You have a lot of these startups with not a lot of revenue, but huge amount of paper wealth. Back then, the IPOs created liquidity. Now you have all these private companies that can stay private until they get to be worth $500 billion. The downside for employees, and the reason OpenAI is doing this, is that there is less liquidity. So you're right, they're all in on these assets are locked up now on paper, and these valuations are not guaranteed forever. So that's a big difference between now and the late 90s.
Is it also different that you see multiple billionaires coming from the same companies? The fact that, I mean, it feels like before it used to be there was the one billionaire and they were the founder and they kind of had a bigger stake. Now it seems like the wealth is spread out a bit.
It's a great observation. Something that I found in researching this article is back in the dot-com era, you would have a single founder, maybe a second founder, really 1 or 2 people typically. These are all seem to be these teams that are put together. It's like the boy band approach to AI, where you take 3, 4, 5, 6 people. A lot of these companies have 6 or 7 co-founders, and their stakes therefore are going to be smaller, but the valuations are so high. But it does seem there are more founders in AI companies than there were in the dot-com bubble, but still a lot of wealth.
It's like NVIDIA and Sync.
Right, exactly.
Do you see any trends that they are trying to expatriate any of their wealth?
Not yet. And again, you know, it's so early. No one knows how much of this wealth is going to last or real, and you can't get it out of the companies. And, you know, the wealth managers are salivating over the potential of this wealth boom, but we haven't seen it really come into the economy or into the wealth management business. That could be the next phase, could happen quickly if we start to get some IPOs and exits.
It's all about the exits, that's for sure.
That's right.
Robert, thanks.
Thank you,
Fascinating
guys.
story, Robert Frank. Still to come this morning, we'll get a read on commercial real estate with the CEO of JLL, who says office demand is in fact holding up, but called out weakness in a different part of the market. We'll tell you what it is when Money Movers begins after this.
com. NBC Plus.
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, stalled stocks. And the big question facing the investment committee today, can the record-setting rally regain its momentum? We will ask. Joining me for the hour, Joe Terranova, Liz Thomas, Malcolm Etheridge, and Steve Weiss. Stocks, they are modestly higher today. We will have a lot more on that in just a moment. We're going to start, though, with our stock of the day. It is Apple. It is having its best day since May 12th. We've talked about it on this network all morning long. We've even thrown it on the screen for you there. It's up near 6%. So they're boosting the U.S. investment by $100 billion to $600 billion total. The White House says that Apple's going to remain largely unaffected by the tariffs that are targeting India. Tim Cook's going to be at the White House this afternoon to meet with the president. He says he has a good relation with President Trump. And Joe Terranova, who just sold Apple in his latest rebalance in the ETF, has bought the stock. And he's done so personally. Why'd you do that?
Absolutely have to do it. First of all, there's a lot of people who have made great calls. One of them is sitting on this desk. Gentleman to my left, Malcolm, great call down at 190. Josh Brown made a great call on the show yesterday as well. Scott, I've mentioned to you over the last several days that personally I wanted to own Apple. But my purchase of Apple this morning, and it was done in the pre-market. Yes, all the haters out there will say, no, I didn't. Trust me, I did. I came right out and knew that I had to buy it. And the reason is positioning and sentiment. And those are the two things I rely on. I'm always looking at where is everyone positioned. And universally, momentum funds, myself included, paring back the holding of Apple because of the significant underperformance over the last 12 months. That is with certainty. Growth managers carrying Apple at an underweight, leaning more towards the NVIDIAs, the Palantirs of the world. It's almost like you're short. It literally is like you're short. And I think right now, collectively, you have all of the quants, all the algorithms that are participating. And as price, if you are worshiping price, if you are chasing price, then you have to go in and you have to buy Apple today in your fund.
Josh Brown, since you referenced him, yesterday on this program said, quote, Apple seems to be finding support here. Doesn't seem to want to go down anymore. We shall see. Malcolm, you've suggested to buy it as well. You own the stock. What do you think about buying it right here based on this news? We were talking before the program. You said that Tim Cook's been acting more like a diplomat than a CEO lately, and maybe that's paid off. Maybe that's why he's so good at what he does and how he's been able to manage his relationship with President Trump, which has publicly appeared to be a little dicey at times.
Well, Tim Cook and Jensen Huang, I'll throw him in that same category. Both of these guys' chief job is basically being a diplomat right now because if not, they both have a China problem, right? And so for Apple to say we're going to spend another $100 million investing in building in America, probably in Texas, we haven't heard the announcement yet, 4 o'clock or so this afternoon. I think that realistically, what we're talking about is Apple trying just to make sure that they stay out of the ire of the president here.
I find it interesting, Joe, just to come back to you for a minute, because you run this rules-based ETF. That dictates to you whether you can add the stock to your ETF or not. You don't have a discretionary decision to make. It's all dictated by what the rules tell you, in part based on momentum or the lack thereof that had existed in this stock, which prevented you from adding it to the ETF. But now you see momentum gathering that the stock has turned the corner, so you can add it personally. Can you square those two things for me? Because I have a hard time getting my arms around that.
In addition, by the way, if you look at the quality factor, the revenue growth has kind of flattened out. The revenue growth has not been there. The significant weighting of Apple in the S&P 500 presents a little bit of a problem from a portfolio standpoint. In particular, when you know that at a certain point you have a potential bullish catalyst that's going to affect price, and you look around and you say to yourself, where are we in sentiment? Where are we in positioning? And in both those instances, the suggestion that I am understanding from that leads me to believe that you have a lot of people that are going to have to step in and buy the stock, and that's what I'm focused on. I'm focused on the positioning and the rebuilding of the positioning, because you have to get back up to that significant market cap weighting that it has in the S&P 500. I've also believed that there has been a tremendous amount of resiliency since April in the stock. It's appeared several times like the stock is going to break down. And I've said on air, Apple does a really good job of almost paying you to wait.
I mean, it's been sideways, right? Look at the chart from April. It had the rebound from the April low like everything else seemingly did, and then it's been a sideways mover.
Correct. While everything else is kind of rallying, Apple's trading in this sideways range.
So
you also have the ecosystem. And the ecosystem, while the stock might not be performing well, the ecosystem remains pristine, and people still go out and buy those products.
Your focus is on positioning. Mine is actually on sentiment. So you gave me the two sides of it. I think the fact that for the last year and a half, roughly, since Apple's iPhone sales have been declining, we've been hearing nonstop calls from analysts up and down the street saying, Apple, it's time to do something. It's time to do something. Where's your AI strategy? Negative things to say about the stock. However, no one was taking down their price target. So which is it? Do you feel negatively about the stock enough to take down your price target?
Daiwa took it down today to 230. They had 240. B of A keeps their 240 as they reiterate a buy on it. Now, what's undeniable, if you look at the intraday charts of the NASDAQ or the Dow or the S&P for that matter, Apple's helping the overall market today, given its weighting in the S&P, what it means to the NASDAQ, which is the highs of the day, as Apple is too, and the meaningful nature it's contributing to the Dow as well. So you're basically highs of the day across the board. Liz Thomas, welcome back.
Thank you.
It's so good to have you back.
So good to be here.
Being a mommy is great, I'm sure. And it's great to have you back.
It's lovely.
So we've been a little unsettled. The S&P's down 5 of 6 days, NASDAQ's down 3 of 4. Jonathan Krinsky of BTIG says we continue to think the S&P works its way back to 6,100 as we head through August, to which Citi says, well, that might happen, but you got to buy the dip. So give us your view of this market.
You know, it's funny. I think I went out on March 16th, and if I would have went to sleep on March 16th and woken up today, it would have looked like we're at all-time highs. The market's been sort of unaffected. We just made this little tiny rotation back into growth stocks. But obviously a lot has happened in that period. So I think where we sit today, and I'm not going to harp on valuations. We've done that over and over and over again. I've heard it through my entire leave about valuations.
Maybe the stock market's more expensive today than it was before you left.
It is, absolutely. And when you look at the percentiles, it is. But you still have to look at it from a perspective of, I think, from these levels, the market is difficult to impress, and it's easy to disappoint. That doesn't necessarily mean you buy it with a lot of fervor today, because it's hard to convince people of a really big bull case from these levels. But even to Krinsky's note, if we go from where we are today, 6,350 down to 6,100, that's what, a 3.5% move? Not that big of a deal. It would be an opportunity, and I do think that this uptrend can continue. You just have to make the bull case with different points. Things like the economy is still stable, just slowing. There's room for more multiple expansion in the AI theme because enthusiasm will win that day. You've got a lot of macro data points that maybe are softening, but they're not screaming alarm bells, right? And I think you have to stay on this train of you want to be invested in U.S. tech. You have to stay invested in it because that's where the innovation is happening.
I got a whole list of reasons that some would suggest, Weiss, that you should stay bullish. What are the catalysts to keep this rally intact, to get this market jump-started once again? Maybe buybacks. Maybe what Joe has talked about, that's one thing. Apple buys back more stock than anybody else. That's always been considered to be a floor under this name. CNBC Pro today says this is the stock market's secret sauce. Buybacks are pacing for a record this year. July saw a record $165 billion in announced buybacks. Year to date, we've now hit $926 billion. One of your favorite stocks, Uber, today, $20 billion buyback. What do you make of all that?
Yeah, well, I wouldn't call Uber one of my favorite stocks because it's not a top position. Look, like Apple announcing, a bigger spend in the U.S., companies that announce buybacks, they announce them. It's when they buy back the stocks that matter. So announcements just don't drive it. It's what they actually do in the market. And in terms of, just go back to Apple for a second, and this goes to the overall market. What's driving the market is momentum. And just like neither of, whether it was Joe or Malcolm, not once did they mention fundamentals. So what they're doing essentially, not Malcolm so much at 190, is chasing momentum. So I don't know how to do that in terms of managing to a benchmark.
Chasing momentum in a name like Apple? That doesn't make much sense to me. There has been no momentum in Apple. In fact, they're not chasing it. Maybe they're anticipating, today, but Joe bought it this morning. Frankly, maybe they're anticipating momentum returning. It doesn't feel to me like he's chasing anything other than a great opportunity potentially for a stock that's done nothing since the rebound in April.
Over the last 5 days, the stock has moved up, and it's moved up measurably. So to me, if you define momentum as what the recent prices have been, it's moving it. Now, is it a low-risk hold here? Probably. But the fundamentals are still punk. They still are flat in their revenue. They're still flat in their earnings over an extended period of time. So if you're looking for a laggard, buy it. If you're going to buy it on news that isn't news all of a sudden because, yes, tariffs, then no tariffs won't impact them, then buy it. Me, I'd rather look at companies that are truly undervalued, that have great fundamentals, one of them being Leidos, another being FTAI, another one having been Caterpillar. So that's where I choose to play. In terms of the overall market, it's indicative of the market. The market goes up on not much news. It goes up on the absence of bad news or on bad news going away, as we've seen, repeatedly with tariffs. So look, 90% of companies so far in the second quarter versus the first quarter, meaningful increase have mentioned tariffs. 84% mentioned uncertainty, according to FactSet. That's still going to influence the market. But
Go
the
intraday
market
on this,
doesn't
guys,
trade
please,
valuation.
rather than this for 2 months, because it's at the highs of the day is Apple, and I reckon that the stock market itself is too. You're pushing 6% gain. Sorry to cut you off, Weiss, but you want to respond to this, Joe?
Yeah, I disagree, Steve. I just don't see that the last 5 days the stock has been up significantly. It fell after earnings. It had a good earnings report. Post earnings, it was up. But look, we just have different strategies. I respect Steve's strategy. He looks at fundamentals. I'm looking at something different. I'm not necessarily sure how we return the market to an environment where fundamentals, more than anything else, are driving the flows of capital into the market. It seems as though that genie is out of the bottle, and we are in an environment where it's more about physicists and mathematicians who are writing algorithms. And you might want to say they're chasing momentum, but I agree with you.
No, I'm going to go down the list for you and show you why perhaps the fundamentals will be more at play than maybe they've been recently. It was a momentum-driven market by large regard. I mentioned the buybacks. No one does more than Apple. It's the secret sauce, according to CNBC Pro. I urge you to go take a look at that article as well. You can see it for yourself. The other thing is there's a lot of cash that needs to be deployed. Bank of America today, cash levels are high, and so will the need to allocate. Cash levels today are more than 30% higher than we might expect. You don't like that? Well, how about more dovish Fed speak? Neil Kashkari, he's a voter next year. He was on Squawk. He says 2 rate cuts this year seems appropriate, says reversing course on rates may be better than waiting. Well, that's interesting to hear from him. You already had 2 dissents from Fed governors. You don't like that? How about the fact that the consumer's pretty good still? Raymond James, consumers healthier than government data suggests. Disney beats. Hugh Johnston, the CFO on CNBC, said today, quote, I know there's a lot of concern about the consumer in the U.S. right now. We don't see it. Our consumer's doing very, very well. You remember what Brian Moynihan, the CEO of Bank of America, had to say yesterday? He painted a picture that sounded pretty darn bullish. Liz Thomas, excuse me. It's an adjustment.
That's only going to happen for a couple of years.
Yes, exactly. Give me time. I'll call you Liz Young Thomas for a little bit. I'll call you Liz Young. It'll take me a while to get to Liz Thomas. Exactly. So what about that? What about all of that? I just made a pretty big case. Is it believable?
Well, so when we think about the consumer spending has been a topic that we've belabored for a very long time. Inflation should have eaten into it. We should have been stretched a long time ago. Credit card debt had gotten to these all-time highs. That should have been a problem, especially with interest rates where they were. I could go on down a list of why the consumer should have been under pressure. The consumer has been under pressure. What's happening right now is because goods prices have increased. When you look at things like core goods, ex autos, so the stuff that people spend money on besides cars, it's increased a lot month over month. I think it's up 0.6% month over month, and that's the highest level that it's been in a while. Consumers are just making choices now. So we have to spend more money on goods, which means we're going to spend a little less money on services, and then you see the market react to that accordingly. It's not that consumers have pulled back across the board and said we're not going to spend. Mm-hmm. So I do still think we're in a good place. And I have long said and still believe the consumer will keep spending as long as the consumer is employed. Now, we had a rough jobs report last week, but it wasn't negative, right? We didn't contract in jobs.
Right, because as Brian Moynihan said yesterday,
less than we thought.
Job growth slowing is different than jobs being eliminated.
Exactly.
We haven't seen layoffs.
That's right.
So the labor market slowing a bit. You want to be negative, the market, in the face of what I said, all this cash that needs to be deployed, Fed speak becoming even more dovish. You know rate cuts are coming. It's just a matter of when, not if. The consumer's hanging in pretty well. Oh, yeah, and the idea that the mega caps are going to continue to lead this market higher, that the money's going to continue to flow to the best and the biggest, and therefore the market's going to go up. At least the S&P, even NASDAQ. Hold on, Weiss, I'll come to you in a moment.
Even given everything Liz just gave us about the consumer and all the yeah buts that the consumer has given us in return, right? Yes, I should be negative, but I'm still outspending. I'm still of the mind that we should be focused on spending our dollars, or investors should be buying companies where enterprise is who they rely on, not necessarily the consumer. So yes, the consumer has shown a lot of resilience, but when I look at the companies that have done 25% or better year to date, I'm talking about Microsoft, I'm talking about Nvidia, I'm talking about Broadcom. None of these companies sell anything to the general public, but when I think about the companies that do touch the consumer, Tesla, Apple, Amazon, they're negative year to date. And so I'd much rather own anything that's enterprise related, enterprise tech especially, rather than relying on the consumer right now, which if there are cracks in the system at any moment, those cracks could start to really break out. And now we're talking about trying to catch
let's
a
be
falling
clear.
knife.
I don't bring up the consumer number as a question as to whether you should buy retail stocks. No. Those are two different arguments to have. But if you have a 2/3 service-based and consumption-based economy and the consumer's hanging in there, my point to you is, were you really going to get negative as long as the consumer continues to hang in there, and as long as the job market remains, at least maybe it's tightening, maybe you're going to have a slow of job creation. But as long as you don't have layoffs, that changes the equation altogether. You want to get negative the market in the face of that?
But at what point does that break, right? How many layoffs is enough to suddenly make the entire street decide maybe we ought to go in a different direction, right? We're starting to reach a capitulation around the idea that something's got to go wrong because we're all feeling too good right now. That's the mood with all the different investors that I talked to today. And so if you think about where you usually are supposed to zig when the market, when general consensus zags, I think that's probably a case for if the labor market does start to show one more crack, is that enough to start to force us in the other direction?
I don't know.
I just don't want to be in position to have to catch it.
Though. Like some of those measurements have already hit and the market still held up, right? I remember when the SOM rule hit and everybody freaked out. And then there's another measurement, I think Gunlock talks about the moving average of unemployment when the 3-month moving average gets above the 12-month average, something like that. I don't know exactly. All of those metrics have hit already, and it didn't fall apart. And I am guilty as charged, somebody who looked at all of those and said, uh-oh, here we are. Here's the precipice of disaster, right? Just waiting for this next big thing to happen, but then it didn't. So I'm not saying that it won't, but you can't invest based on just waiting for those metrics to then tell us, okay, surefire, this happened, here's the number, now we're headed for recession, because this has, again, been the recession that just never came.
That's right, Weiss. The what-if investor has been run over by this bull train.
Yeah, no, absolutely. And look, it's just an unusual market. I've said repeatedly, we've got a different cohort, a different population that are investors now and active investors, and they really don't get focused on fundamentals. Just want to take 1 second to address what I said about momentum. I'm not a momentum trader. I believe in the strategy, which is why Joe T is one of my larger positions, because I know Joe does that well. Now, back to everything you mentioned, but I want to focus on the consumer first. Moynihan came out and said consumer spending through the end of July is up 5%. Malcolm's point was that we've got Microsoft, we've got Nvidia, we've got, Apple. The CEOs, they're all diplomats. Well, guess what? So are the CEOs of other companies. Everyone, because everyone could be singled out. So Moynihan in particular, he made that comment. He made that on the heels of being attacked for not banking conservatives. Now, July is an important date because you're a consumer. You went to buy a car. It said buy before the August tariffs hit. So there's a lot of pull forward buying. Don't take past as prologue. That's going to peter out, and we're going to see it peter out. And yes, credit card balances remain high. So there's a danger of being complacent in this market.
So are you negative the market again? Now I'm confused, Weiss. Where do you stand on this market? Are you growing negative on the market again?
I'm fully invested till further notice. But if you look at my positions, which I talk about often, I'd say 70% of my exposure is in big cap tech. So I'm playing it. I own Caterpillar to balance a little bit, FTI to balance a little bit. So I'm staying with the market, for now, but I'm not complacent. There may be a drawdown of 5 to 10%, but we'll recover quickly. So I'm not looking to time this market.
So Malcolm, you have a new buy. Maybe it plays right into what you're talking about sticking with tech names. Chips have been a question mark, not so much in the last few days. Some haven't traded all that well of late. You bought ASML. You want to take me inside that trade and why you decided to add that name, which is only up 1.5% over the past 3 months. And if you compare that to some of the other names that are up a tremendous amount, I mean, it lags so dramatically, it's not even funny. It sticks out like a sore thumb.
I think you just made the case for why you'd want to buy it. As the disciplined investor I like to tell myself that I am, I want to buy into weakness. I don't want to buy necessarily at moments of significant strength. And so what I'm looking at ASML, it's equally as important in the conversation we're having around AI as names like NVIDIA, Taiwan Semi, right? NVIDIA sells chips to about 80% of the global market right now for all things related to AI. Taiwan Semi is their biggest customer, and Taiwan Semi is dependent on ASML. So ASML has had a China problem for some time. They've been talking about it on earnings calls, but they've got a 50+% profit margin over that same period. And I think we're at a place now where we can start to look at them turning the corner, because the AI conversation has shifted now from being on laptops and PCs to now going mobile. Well, what does that mean? It means they're going to need to refresh that equipment, they being the actual foundries that are making these chips. They're going to need to refresh the equipment, buy new equipment that they use to get smaller and smaller nanometer chips into their sets. That's going to all benefit ASML.
You like the chip equipment names because you just added a couple to the Joe T. KLA and Lam were also added to Bank of America's global contenders list. Those are the two names that you just added in your rebalance. What do you think of this move? Do you like it?
So I do, because what I see in the semiconductor industry is, number one, I see tariff relief. Number two, I see the potential for clarity surrounding the restrictions with China, although in the case of AMD today, that is why the stock is clearly down, because the MI 308, they were unable to include that revenue in the upcoming quarter. Street obviously didn't like that. But you're talking about an industry where you're not going to get the type of earnings growth that's being exhibited anywhere else. You're talking about 30% earnings growth from the semis, and the semis once again are coming back. I think ASML will participate. I know Steve has a Taiwan Semi, which has done remarkably well. And at some point here, as we move through the third quarter, you're going to hear from Broadcom, which has been the sleeping giant amongst all these semiconductor names. So I think the momentum is building for semis, and I think that'll continue through the remainder of the year.
All right. Up next, we're going to do our calls of the day. We have a big upgrade today for a defense name. It's up 8% this week. Someone on this desk owns it today. Halftime's back in 2.
now and make it count.
All right, we're back. Calls of the day. We start with a stock that Weiss just mentioned a few moments ago, one that he absolutely loves, unless he tries to refute that too. Leidos, because that's just the way you are, Weiss. Leidos upgraded to buy from hold, the target to 205 from 185 at Jefferies. Why don't you tell us why you love this so much, Steve?
Well, I've gotten to know Tom Bell, the CEO, pretty well, and went in there before I bought the stock to talk about it. And their new management, essentially over the last couple of years, and they came out with a plan, and they've executed perfectly in line with the guidance they laid out and their methods of operation when they took over. And that's come to fruition. And put this in perspective, the DoD came to 10 companies, Booz Allen being one, the large government contractors, Lockheed. And what they said was, you got to give us back something on the contracts. And Leidos is part of that. And so Leidos, 30% of their headcount is embedded in the government. So they're able to navigate through that. So the business continues to grow. They continue to beat and raise. The stock's not expensive. Jefferies came out with a target of 205 and upgraded at this level. I think there's a lot of upside here. So it's a bet on management. It's a bet on what they're doing in cyber and everything else that is the soft part, I'd say, of the defense market, not meaning soft as you touch, but not metal benders. So high margin, I like it quite a bit. And would consider to add, pull back.
Okay, thank you. Eaton, target hike to 425 from 375, overweight, Morgan Stanley. We think the margin headwinds will prove transitory. Valuation already discounted versus its peers. Joe, you own it. What do you think?
In the A block, we were talking about the fundamental tailwinds for the market. And one thing I think we left out has been earnings. Earnings continuing to deliver overall for the S&P, and in particular in the industrial sector. Eaton, classic example of really high expectations. Stock was performing remarkably well going into earnings. Earnings were reported, stock falls. There's your bad price action. You take the other side of that, in particular where it is right now, technically at the 50-day moving average. But you turn back and you say, what do these earnings look like? They are participating in the infrastructure, the data center build out. Data center orders up 55%, revenue up 50% accordingly. This is not something that you move away from just because it looks like everyone's appetite is full and they don't want to eat dinner. They're going to come back tomorrow. They're going to eat breakfast, lunch, and dinner again.
Okay. Caterpillar, Weiss, target goes to 507 at Truist. Target goes to 495. Bank of America, you talked about this stock as well.
Yeah, look, I bought this for exposure where I didn't have it at the time I bought it. It was let's say, less expensive than it is now. I viewed, quite frankly, as fairly valued. The quarter was good, but I'm not very excited about it, even though it's a core position. I'm going to ride with it because, again, it's counterweight to what I have elsewhere. And let's face it, with increased onshoring, they should participate. The risk is, of course, if Ukraine and Russia settle their differences, then you could see more commodities come onto the market outside the U.S. and also lowering commodity prices. So that may soften demand, but I don't see that happening anytime soon.
All right, Liz Thomas.
Just call me Liz.
Industrials. Industrials. Weiss is so distracting that it distracts me when I come off from him to you, and therefore it happens.
I'm a magnet.
Yeah, but nothing good. Bad things stick to you, Weiss. Industrials are the second best sector year to date. Do you like them?
Are. I mean, look, it's always hard to like something when they're doing so well. You worry about when it's going to turn, but I do still like them. And there's a lot of economic activity that, again, has been warning us that something's going wrong. But industrials, especially the capital goods sector of industrials, has been doing really well. And I think you still can own them here. The same rules apply to when you're looking at mega cap tech. You see companies that have gone up a ton. They're at all-time highs. They're way above the technical levels that they should be. Just be careful of your entry points.
I'm just going to call you Liz.
I'm
not even going to make it complicated on myself. Why would I do that to myself repeatedly? Whatever. Axon.
Yes, sir.
Axon. We talked about this yesterday.
Sure did.
This has been caught up in meme mania, in cultish stock activity.
Let's raise that a little bit. Yeah,
So
it's cultish. Well, the law enforcement industry is certainly behind this stock with good reason.
Is this the former taser?
Yes. They have the technology that's in place right now that's servicing that industry.
Okay, the target goes to a street high $1,000 at Bank of America. Are you refuting the fact that it has been caught up in that mania a little bit?
I think it's
a retail happy name.
Look, it's a mid cap stock. I think it's very similar to what you're seeing in AppLovin and Palantir. I don't think it's like seeing what you're seeing in some of the other stocks. I mean, it is delivering the revenue growth. Here's how you look at the stock.
What do you mean in some of the other stocks? You said yesterday that you can take Palantir out. You can take Palantir out of it. You included AppLovin with this and something else yesterday as in the cultish thing. No.
The momentum cult, Scott. The momentum cult. I think we're having a difference of the way we're looking at it. You're telling me these are meme stocks. I don't look at this as a meme stock. I think of a meme stock, and I don't want to offend anyone.
I said a cult stock, cultish stock.
I think it's momentum cult for sure. Absolutely. It's the cult of momentum.
There are different grades of cult stocks?
Well, listen, there's some real earnings behind these companies. So I don't want to disregard that. I think some of the meme
there are real
stocks,
earnings behind Palantir, too.
and that it can be included in the classification that I'm describing. I think some of the meme stocks, I don't think they're delivering the earnings that some of these companies are. There is
which stocks would you characterize as meme stocks?
I'm not going to offend people out there. You know the stocks out there that have been rallying.
But now I don't. I thought I did. Now I don't.
I'm not going there. Let's talk about Axon for a second. All right, it is a clear momentum-driven stock. Yes, supported by some revenue growth and good revenue growth and earnings. But in addition to that, the way you look at the stock right now, first of all, analyst community, 88% buy rating on the stock. Average price target, $884. Price target's going to go higher. Yesterday's low at $800. If you are risk managing the stock, if it goes below $800, maybe you want to reduce your position if you have discretion and the ability to do it, because it should not go back below $800.
Is American Eagle a meme stock?
No comment.
I'm gonna back you up for 1 second and potentially even bail you out.
Please do that for the next 20 seconds.
And say, if you look at the 5-year chart on Axon, it has been a momentum stock for 5 years, right? Mm-hmm. Earnings growth has been pretty solid since they made the shift from being a hardware company selling tasers and body cameras to realizing that they are a software company and they can sell subscriptions to people. And that was what really expanded the growth in that company. So for that one in particular, the rest of the names you mentioned, I got no bailout for you. But for Axon specifically, I think that's where the real shift happened for them.
All right. He appreciates you very much. Christina Partsinevelos joins us now with the headlines. Hi there.
Hi, Scott. Fort Stewart Army Base in Georgia right now is on lockdown after a report of an active shooter. In a Facebook post, the base said there are casualties, but didn't offer any additional details. Schools in the area were also locked down. Fort Stewart is about 40 miles southwest of Savannah. Vice President J.D. Vance is set to host a dinner with senior administration officials tonight. Reuters reporting officials include White House Chief of Staff Susie Wiles, Attorney General Pam Bondi, and FBI Director Kash Patel. They are expected to discuss how the administration handles the fallout over the Jeffrey Epstein case. And a 7-year research study on Alzheimer's disease found lithium could play a major role in early detection, new treatments, and also understanding just how a brain ages. In the study published today in Nature, scientists at Harvard Medical School found they could reverse the disease in mice with small doses of a lithium compound and actually restore some brain function. Very cool stuff. Scott.
All right, Christina, thank you very much. Christina Partsinevelos. Coming up next, more committee moves. Malcolm ready to talk about 2 stocks he just sold. We'll tell you which ones next.
now.
So let's talk about Malcolm's moves. I said he had a couple, and they're both sells. Number one, Iron Mountain. Why so?
Yeah, so if you're a dividend investor, this is still a great stock for you to own. But for me, I sold that when I had earnings just on the expectation that I looked at what happened with the big banks when they reported. I looked at what happened with big tech when they reported. Great, solid earnings numbers, and the market still responded by selling their shares down. And so I expected the same thing from Iron Mountain, and so far that's what we've seen. But I've been in this name for the past year and have nothing to show for it but a 3% dividend. So if you look at its valuation in comparison to its peers in the XLRA, I don't think that it's going to take off in any meaningful direction anytime soon. It's probably going to continue to trend
Why
down.
do you think the market's been doing that? The way that some of these stocks have been reacting post-earnings, the way they have. Expectations just got too high on some names?
I think it's sentiment. I think even though when we look at the year-to-date number, the S&P is still doing single digits, it feels like, if you just think about April 9th, the snapback that's happened since then, it feels like the market is doing significantly better than it is. And I think that investors are just looking to take a breather, take some profits here, and wait for the next thing. I mentioned before, consensus seems to be we're overdue for a pullback, and everyone's trying to position themselves for that pullback.
Including you.
Including me to a degree, but
Well,
I'm
you
actually
sold Prologis,
I
too.
also bought ASML with the proceeds. So I'm using the cash to get in position for things that I think are going to happen looking forward. I think we're probably due for a rate cut that's going to set up great opportunity to buy in names like fintech.
Why'd you sell this?
So I sold Prologis similarly, but it's been a dead stock for me. For the year that I've owned it, it hasn't actually done well. And if you look at vacancy rates, they brag about a 95% or so vacancy rate, but across the industry, that rate is increasing. And
Let's see a year.
And so sentiment in that name,
go.
it's been a round trip basically for me since I've owned that stock. And again, I've only got a 3% dividend to show for it in the time that I've owned it.
You ever own this?
Yes, the ETF loves to buy this. We have not had much luck as you've described.
Yeah. What do you mean loves to buy this? When was the last time you owned it?
The ETF has owned this several times. I believe that we owned it at the end of last year. I'll pull up my file in a second, but we've owned it several times. And we haven't done well with it.
Are your numbers reliable this time?
Oh, boy, here we go.
All right, still ahead, Mike Santoli's Midday Word. That's coming up next. back on the Halftime Report. Our friends at Golf Channel following the PGA Tour stop this week at the FedEx St. Jude Championship. Reporter Todd Lewis joins us live from Memphis, Tennessee, with what to expect as the playoffs begin. We're really excited about this.
Yeah, why wouldn't you be? It's a great tournament here to start off here in Memphis, where it's going to be hot and guys will be sweating on and off the golf course as they try to advance ultimately to East Lake in Atlanta for the Tour Championship. Scotty Scheffler has really no worries. He's number one in the FedEx Cup standings. He will be at East Lake. Last time we saw Scotty Scheffler, he was walking around the 18th green at Royal Portrush in Ireland holding the claret jug. Well, since then, he's had a little bit of downtime. He did go to the Netflix premiere of Happy Gilmore 2. He's one of the players in that movie, one of the many PGA Tour players. And if you've watched him in that movie, you might say, hey, he might deserve a Best Supporting nomination for a PGA Tour player. I'm not sure that's an Oscar category, but regardless, he's in a great frame of mind heading into the playoffs. Now, this is a big week for players trying to advance to next week's PGA Tour playoff event, and that is the BMW Championship. You advance to that tournament, then you are set for all of 2026 to play any tournament you want, especially the signature events, which have more money and more FedEx Cup points. And players this week, big players, need to make a move, like Wyndham Clark, Jordan Spieth, Ricky Fowler, Xander Schauffele. You can see all the action on Golf Channel Thursday and Friday, and on Golf Channel and NBC on the weekend. Scott?
Important to note, too, Todd, Rory's not there, and really the only one of the big names who's skipping the first round of the playoffs. Why so?
Well, you make a great point here. He is skipping this event. There's supposed to be 70 here. There's 69. Rory's not here. One big reason is the fact that the Tour Championship has changed its format. It used to be the guy who was leading. The last 2 years, it's been Scotty Scheffler, would have a two-shot advantage over the rest of the field. Well, that has been eliminated. All you need to do is make it to the Tour Championship. Any player, positions 1 through 30 in the field, if they win that tournament, they win the FedEx Cup. Rory is a lock to be at the Tour Championship, so he says, why do I need to come here if I'm going to be in Atlanta in a couple of weeks?
Oh, interesting. Todd, thank you. That's Todd Lewis, live for us today in Memphis, Tennessee. Mike Santoli, he's next.
It's the place.
We are back. Senior markets commentator Mike Santoli. He's just sat down at Post 9 for his midday word. Thank you, Apple.
Yeah.
Otherwise, it's kind of the same kind of market you've been talking about.
It's almost 50-50. I was just looking. It's like on the NASDAQ and the New York Stock Exchange, 2,300 stocks up, 2,300 down. Apple is about half the net gain of the S&P 500. And then maybe if you think there's more in there, it's underperformed by 2,500 basis points versus like the NASDAQ 100 this year. So that seems a bit of catch up. Still a net negative cast on the earnings reporters. I mean, you have McDonald's up, but then Disney getting hit. Emerson Electric, a big drag on the S&P today. That follows Eaton, you guys were talking about earlier. So there's just this rethink going on in terms of how much was priced into the good earnings. But I think it's going to net out to earnings in aggregate did their job, you know, to sort of substantiate where we are. It was a crazy twitchy trade in treasuries right around 11:30. 10s went from like 421 to 426 as pulse trade, and then it came back down. Very erratic, and it seemed like it was connected to Kevin Warsh's poly market odds crashing by 20 percentage points. I mean, weird stuff happening in a quiet day. It doesn't seem necessarily to lead to much in terms of tangible until we get claims tomorrow, because I think we're going to be checking every piece of new data against the revised labor market report we got last week.
Well, because we're trying to figure out, and Liz, you can comment on this too, what the next big catalyst is going to be. Earnings season's winding down. You're not going to have Jackson Hole for a little while. It's going to be hanging on every single economic data point now that comes out.
Well, I mean, the next big catalyst, I think, is the Fed and whether or not we get that rate cut. The market wants the cut, but we've got a lot of data that comes out between now and September 17th, I believe is the date. So we've got 2 more CPIs, 2 more PPIs. We've got another jobs report. We've got Jackson Hole, as you mentioned. There's a lot that could still happen. If any of those reports come in hot, we're not getting the cut, right? And the market is going to be really disappointed in that. If we get the cut, I think you see continued upside. I think you see that catalyst and the support that we need from the Fed.
You get the tension is only building between the two mandates.
Sure.
Because inflation
and next
still
week is for
higher,
CPI.
right? And then the labor market now is in question.
Yes, and you got 6 weeks until the meeting. Now, one thing you know about the Fed is you're going to have it priced before the meeting itself. Whatever's going to happen, you're going to have a sense of that. The question is, what has to happen in the data to get the outcome you think you want?
Right. And right now, the market, 94% pricing for a cut. But again, we've got, 6 data points that could swing that in 10 minutes.
Yeah. See you on Closing Bell. Okay. That's Mike Santoli. Finals are next.
TrumpMatters.com.
At Invesco.com.
Easy choice.
All right, is it really? All right, we'll find out more about that after I tell you what's coming up on the closing bell. Dan Greenhouse, Ashley McNeil, Stephanie Link, Allie Flynn Phillips, Jonathan Krinsky, and we just added Dan Ives because Tim Cook's going to be at the White House this afternoon, and we want to hear from Dan Ives about that. Now we'll hear from Liz. I learned my lesson. Liz, final trade is what?
It's financials.
Okay.
So I talked about the recession that never was. We've got economic resiliency. I think financials can benefit if we get those rate cuts. Valuations are not as bad as some other parts of the market, and you need something to diversify that growth overweight.
All right, there was another positive call on that group today, as a matter of fact. Steve Weiss, do tell your final trade.
Uber, like why not? I mean, it's going to be a permanent compounder, build that reputation. Quarter was good. The buyback will happen. So
very
I'm
funny, since when I
Uber
mentioned it's one of his favorite stocks, he immediately tried to refute that, but then uses it as his final trade. That if that is not Weiss in a nutshell, I don't know what is. Malcolm.
Rocket companies, looking at stocks that should do well the moment we get that first cut Liz was talking about.
Walmart. All right, I'll see you on the closing bell.